Hello everybody, Randy Patrick here. Time for Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. More news this week, stuff going on. Let's get to it really shortly here. Today is Thursday, June the 27th, and if you'd like, please help my channel grow. Click that subscribe button. I would really appreciate it. Thank you. Now, also feel free to reach out to me with your real estate questions and concerns. I know a lot of you have, and I'm in process with a lot of people right now, so that's great. So again, the best way to reach me is to hit me an email. That is the best way, and it'll be in the top comment. It's on the About Us information section, and I'll put it in the top comments, the pinned comments for the video as well too. So today, my topics are going to be kind of interesting today. There really is a massive market disruption going on in the real estate and housing market today, and I think it's going to have some long-term effects for us, and we have to understand what's happening so we can deal with it. But again, just the other day it occurred to me that we have a lot of disruption happening in the marketplace, and I think it's just it's time that things change, and they're changing right in front of our eyes. So we'll talk about that in a second here, but I want to go through the news. So apparently news today is pending home sales roar higher but are stuck below year-ago levels. So numbers, I guess the pending home sales jumped by a seasonally adjusted 1.1% in May, but were 0.7% lower than a year ago, so in May 2018. That's according to NAR, National Association of Realtors. Basically, this index, the pending home sales, is tracking home contract signings, and this basically may mark the 17th straight month of annual decline. So every year, or so every month, the year over year is declining as far as pending home sales are concerned. Obviously, this is a contract signing, so this now represents future closings. So typically 45 to 60 days out is what we're looking at here on average. So again, this is, if this is slowing down, then our future closings will be slowing down as well too. So big picture, I guess this is from Market Watch, and I guess their comments are the housing peaked for this cycle in late 2017, which is kind of consistent to where we hear a lot of the analysts have mentioned that before as well too. Combined sales of newly built and previously owned homes have stagnated since then, and you've got occasional upticks here and there, but the rest of the economy is slowing, and it's not likely we're going to see anything major happening that's going to increase the sales and values in the housing market. So that's a scoop on that. But I have to laugh though. This goes to show when we talk about the media and how everybody puts their spin on things, and pending home sales roar higher. Well, a 1.1% month over month increase to me is not a roar whatsoever, right? So that's just my perspective. Adam Data Solutions put out their Q2 2019 U.S. home affordability report, and again, it shows that the median home prices in the second quarter of 2019 were not affordable for average wage earners in 74% of the country, all right, or 74% of the counties that the report analyzed. So let's be clear here. Basically, the largest populated counties where median home price second quarter was not affordable for the average wage earners included Los Angeles County, Cook County, Chicago, Illinois, Maricopa County, Phoenix, San Diego County, California, and Orange County, California as well too. So basically, most of the unaffordability is happening over on the West Coast, with a little bit here and there throughout the middle part of the country. So again, and how they calculate this, they basically take assuming a 3% down payment and a 28% maximum front end debt to income ratio. As far as mortgage prices are concerned, that's what they're using as a calculation to gauge affordability. So there you go. Home price appreciation is outpacing wage growth in 40% of the markets. So we knew that, and take a look here. 61% of markets are less affordable than their historic averages. So again, lots of information going on here, but as we all know, it's just more difficult these days to afford a home. If prices are price appreciation is slowing, but I think we see something else happening at the other end, which is wage growth and job loss and things like that. So that's probably what's messing around with the marketplace. This is interesting. Baby boomers creating near gridlock by aging in place. So Obviously, with respect to the inventory shortages out there, so obviously more inventory comes in the market that reduces some price points. It gives us more to buy, more choice, more competition, etc. Good for homeowners and home buyers, right? Well, apparently baby boomers account for 75% million Americans, and why we have this gridlock is because they are deciding, or they're opting to age in place. So unlike maybe a previous generation who would sell their home and retire and go to a retirement community, downsize, whatever, the baby boomer generation prefers to stay in place in their homes. This is according to a Freddie Mac analysis that was conducted recently. So a study released in January by Chase Bank found that 76% of baby boomers own their own homes. The story said about 66% of homeowners think that home values will rise, and 88% of them are planning to renovate within the next 3 years. So that's 2/3 are basically thinking they're going to get more equity out of it, and they're also going to renovate. So they're staying in place and they're not moving, as far as we're concerned here. Baby boomers tend to think that the house has been good enough for them, that it should be good enough for the next generation. And the conflict is underestimating and understanding the repairs. Boomer might think that an older electrical service or older plumbing is fine, but to a millennial who could possibly purchase the property, that's flashing dollar signs because they know they'll have to replace it at some point in time. So again, it's funny that so the boomers generation is not really considering that not everybody has the same tastes or desires with respect to home ownership and style and configuration, etc., size that they do in their property. So thus they're staying longer. There's more gridlock, and these aren't coming to the marketplace. And if they do, it's not necessarily interesting for the buyers, the next buying generation, the millennials as well too. So this is where we have gridlock. To make matters worse for you, if you want to talk about house flipping and gridlock, well. Article about Zillow. Zillow has their, I guess you could say, new company called Zillow Offers. Ultimately, Zillow Offers is really designed to buy your house. They're going to buy your house and they're going to resell it. They may do some work, they may not. So for me, the real issue is that Zillow plans on buying 5,000 properties a month. Now, Zillow Offers is probably only going to work in certain major cities and communities right now. I don't know which ones they are. I'm assuming there's still a fair amount of them. Like the other iBuyers, they're implementing, deploying in the major metros and working their way through that. Funny enough, though, Zillow basically is saying that it's about helping people because it's really the stressful process of selling a home. So this is a stressful process for the average person. Zillow can jump in and buy your house. You can do some quick stuff online with Zillow, and they can give you an offer. And excuse me, the seller then chooses the transaction date within a 90-day period. However, Zillow will offer a service fee that amounts to 7% of the purchase price on average. So nothing is done for free, but I think you take a look at the concept. It's like, let's just get this done. Let's not go through open houses and the listing process and making sure that everything's clean and tidy, and then having to deal with back and forth with sellers and buyers and concessions and financing, all those type of things. So maybe people again are tired of this. That's from their perspective. They think that if they're going to buy 5,000 homes a month, that this is obviously working. They've probably seen some analysis that indicates that they have a market here. So very, very interesting. So when you take a look at this, so what's going on with the housing market? I'm not going to talk about news anymore. I'm really going to get into some commentary, which I think is long overdue. So we have all these news issues that I just spoke about, and there are, I guess you could say, forces of evil messing around with the housing market. We see that there's more and more iBuyers in the market today, and they're hitting major cities first. Then they're working their way through the suburbs. They're gaining market share because if they're deploying, more and more people are using those services, and more people are willing to explore the option, or at least consider them, which is interesting. So, is it a better way to sell your home? I don't know, but maybe it's enticing to not deal with what I talked about before with respect to picking a real estate agent, the listing process, doing all the curb appeal and cleaning and painting and freshening the house up, and then having showings. You got to take off, be out of the house when you have open houses and showings. And then the whole dance with respect to doing a contract and everything that takes place afterwards. So maybe, that this is the attractive part to the homeowner. It's quick, it's easy. You're basically selling to an application, and you're not having to go through all that, and maybe there's some comfort there. We can get everything pretty much from our phones right now, including mortgages, buying and selling houses. So it's a new way of doing things. I think that we have to be prepared. This is going to take shape and take a hold of a lot more people. So not only do we have these iBuyers that are now disrupting the marketplace, and that's when I talk about massive market disruption. This is only going to grow, and more people will look at this as an alternative. So it's only that's here to stay. As simple as that. We now have to compete against investors, and everyone watches TV. Everyone goes to the seminars on the weekends or during the week or in the evening time when the TV shows come through your town or your city, and they talk about fix and flipping and rehabbing and making money in real estate, and they show all these wonderful home run scenarios. It makes people want to participate in the market share of doing real estate as a way to make this your number one income or to supplement or add to your bottom line. So why not do that? So according to Adam Data Solutions, 7.2% of all sales in Q1 2019 were flipped homes, and this is at its highest rate it's been at since a decade, so about 10 years. So which would put us kind of right back to where? Last housing crisis, all right? So that market isn't without issues, though, by the way. Apparently, the industry is also ripe with mortgage fraud, and what we're finding now is that because the market's slowing down, there's more inventory and prices are starting to slow, that more and more flippers are holding their properties longer and maybe getting stuck with them, and they obviously need to get a sales price because you got your acquisition costs, you've got all your costs to repair, rehab, remodel, then you've got your money costs that you got to pay back from the lender, whether it's hard money or private funding or whatever it is, you've got to pay that stuff back. So problem is that and don't forget you got closing costs when you sell as well too. So a lot of that has to come out in the transaction. So they're finding that because it's taking longer and longer to sell, a lot of these flippers are not able to meet those commitments financially, and then may fall into the foreclosure process. And then when that happens, things might pop out. And what does that mean? Well, maybe you're getting loans that you shouldn't have gotten. Maybe flipper was not going to be the owner occupant. It's a form of occupancy misrepresentation. So the point is that what they're making is that we're going to see more and more of these issues this year and next year as property takes longer to sell. People obviously are more concerned about price points, and those that have gambled to say, hey, I'm gonna buy a home and remodel it and make my money on the back end here, are going to have more and more difficulty cashing out and paying off the loans, whether they're private mortgages or like finance, recorded mortgages. It's going to cause them a lot more chaos. So again, that's more competition for us. We also know that there's more larger and corporate investors playing the game here. They're buying homes. They may not be buying like they used to, but there's more of them out there. So some of the massive hedge funds have actually dialed down some of their purchase, but other ones have sort of taken their spot. So they're also raising capital. They've been quietly raising a lot of capital over the past couple of years. So the single-family home rental is now, I think, the preferred asset class to make money. It's solid. It's tangible. If you buy it, appropriately and correctly, you're going to have cash flow. And you're going to have appreciation. You're going to have an asset which can be leveraged, which is great. Well, we know that some of these investors they're buying 1 in 5 starter homes now. So 20% of the market is not going to first-time home buyer starter homes. It's going to investors who are in turn doing what? Renting them back out to people. So now we've got competition. So the first-time home buyers are competing against investors that are typically cash investors. That's tough for them. They're also buying inventory directly from the builders. So to walk into a builder and cut a deal to buy 5 homes, 10 homes, 20 homes, is pretty decent. And I'm sure they're getting good deals as well too, because if I'm a builder, someone wants to walk in and do that, I'm going to say, let's talk. If I can unload a number of properties and somebody's going to buy them with all cash, who am I to say no to that, right? So and to further make things difficult, we know the banks and lenders, are holding back the foreclosed inventory. So there are really actually few bank-owned properties, so they get foreclosed on, they go back to the bank's inventory, and then, in theory, they should come back out to the market on the MLS as what's called an REO, bank-owned, real estate-owned. Well, we know there's less and less of those. How do we know? Well, we look at the sales figures. The most recent sales figures for May from National Association of Realtors, only 2% of all the transactions were distressed properties. Those distressed properties are made up of short sales and foreclosed / real estate homes that are on the MLS. when I say on the MLS, they are listed by a real estate agent via the lender, and they're available to the general public. So to me, that's an on-market property where you can look it up on Trulia and Zillow and Realtor.com, and you can look at this and go, okay, there's an opportunity for me to possibly buy that property. So again, there's few of them that are coming on. We know that significant amount of these investors are buying foreclosed homes at the auctions, or their cash purchases at the auctions, and if it's not actually sold at the auction, it goes back to the lender's inventory, and the lender does not, as I said, put them always back out into the marketplace, because we can tell by the 1 or 2% that actually hit the market. They hoard them and they hold them and they sell them in non-performing asset pools to other institutional investors, hedge funds, real estate investment trusts, whatever. So a lot of these properties that are going back to the lenders are either being purchased at the auction, or they're not ever going to come back out to the marketplace. If they don't come back out to the marketplace, that's less homes for the average investor to engage in, and also those homes are not going to enter the marketplace as cheaper properties to assist in driving overall prices down. So it's kind of this hold the inventory, keeping property values at higher levels, not good for the average buyer. Some of the servicing companies, so some of the people that are servicing these pre-foreclosure mortgages, when they take them back, they put them back in their own inventory. They don't put them out in the marketplace. They have their own auction portals. There's auction.com and Hubzu, and those are online auction portals. Now they're different than the county auctions, where that's like you buy it, either you buy it or it goes back to the bank. These are already back in the bank's inventory, some of these properties, and these auction services are out there, and these portals are owned by the bank servicing company, so it's all connected, and they have auctions, and they have online auctions, and you can look at them online and you can place bids, and usually it's over, it's not like it's happening that day, it's over maybe a week or 2 week period. They want the highest bidder. They have reserve prices. They're going to charge you a buyer's premium fee, typically of 5%. And the issue is that because they have reserves, you may have won the auction, but they may come back to you and say, oh, guess what? Didn't meet our reserve price. So even though you won the auction, we're not going to sell you the home. There's no obligation there. And they're going to wait for a week or so, and they're going to put it back on the marketplace. So they're kind of messing with the market, trying to get the best price, which really is making it difficult for home buyers. Now, I can tell you that right now that, this is not probably a comfortable thing for a lot of owner-occupant primary home buyers. You really have to, it's buyer beware regarding, title clouds, other liens that's still with the property, the condition of the property. You may not be able to get in and check out the home. So again, it's not something that is probably right up every average home buyer's alley, is what I'm trying to say. And again, difficult for the average homeowner to navigate this minefield. Too many unknowns to them, and most of people are not aware or educated as to what to look out for when working through auctions like this. It really is buyer beware. So it's clear to see that the market really is going through some huge disruption, and from many different perspectives. I look at it today, it's more difficult than ever to buy a home. You got price points, you got lack of inventory, you got a lot of competition we didn't have before. Affordable homes are the segment that I think are the worst off, clearly, and clearly most of the buyers fall into this category. Clearly, a lot of the investors would like to purchase in this category as well too, because they are more affordable. So we seem to have this segment that's really getting bombarded, with a lot of I guess you could say, so the disruption and a lot of the efforts in this market segment. But I also see a trend here that I think needs to be addressed, and it gave me pause for concern the other day, because I'm getting a lot of emails from everybody out there, which I appreciate. I'm talking to a lot of people, and I've kind of noticed a trend here, and the trend really is it's waiting. So everyone is waiting to buy, and you're waiting to buy a primary home. You're waiting to buy an investment home. You're waiting to see a significant or material drop in the values before you pull the trigger. And our issue as consumers, as average home buyers, maybe even average mom and pop investors, is that we don't know what the price points are going to be at. We don't know how much it's going to drop, and we don't know when it's going to drop. We have some ideas, but the number one question people ask me is, when's it going to crash and how much is it going to crash? Well, I don't have a crystal ball, unfortunately. If I could and did, I'd tell you guys right up off the bat here. But we do have history. We can go back in time. We can take a look at what happened with the last housing crisis. Well, ultimately in the end, we lost about 30% across the board on a national ubiquitous kind of level. Now, certain markets were more extreme and they appreciated more and they depreciated more, up to 50% or so. Some markets didn't get hit as hard with appreciation and therefore didn't have the loss as well too. So it's all kind of, it's different for wherever your metro is, but the blend was about 30%. Everyone's talking about the recession, how we've seen yield curve inversions, and all the economists are sort of saying end of 2019, early 2020, we're going to see the recession hit. So that's sort of I'm just reporting what you can read in the news as well. That's where I think it's going to be. So again, my point here is that we're seeing a trend with people and waiting. But if you step back as to what's happening right now, the market disruptors, what I kind of envision, which I never really thought about until, again, yesterday, is the fact that they're going to be ready to jump into this market with 2 feet and deep and hard when prices drop. So if you're sitting on the sidelines going, well, I'm going to wait till I see something material and then I'm going to participate, well, it might actually be too late, or they're going to have a head start on getting deals and property ahead of you. So you have to think about that and think about that. So these other buyers, these iBuyers, the other investors, hedge funds, REITs, whatever, they're not going away. They want to buy more, and they want to buy more at cheaper prices. So they're going to be vulturing on this entire market, watching it as it goes down, participating the best way they can. So they're not going away here. So there will always be competition in the marketplace. It won't go away. We just have to figure out how to get to the homeowners before they do. So and as I talk to people, to me, the best way to do a deal is to be direct to the seller. If you have a relationship with the homeowner, with the seller, and you can talk to them, that's great. You have a one-on-one discussion forum, and there's no interference out here. Working through a third party, there's going to be markup, there's going to be fees, etc. It's not going to be the best for you to buy a house. You're not going to get at the best possible pricing point. That's my point here. So again, we got to look at off-market properties, got to look at the distressed properties. This is the way to go. We want to go and engage the market niches that the iBuyers won't hit, that the average real estate investor doesn't want to play in, and that Zillow is not going to go after. That's the things that we want to do. There still are markets available to us in the distressed area, and that's where I think we have to focus. I want everybody to start thinking about this now, because next year when you suddenly want to buy a house and let's get going, you got to look at your mortgage options. Do you have that figured out yet? Do you know what you're pre-approved for? If you want to invest, there's a lot more investor type mortgages and financing out there for cash flow rentals, for fix and flip, for Airbnb. There's a lot more. Need breeds innovation, which brings more products and services to the masses. So right now there's more lenders out there for primary homes, and there's a heck of a lot more lenders for investor options as well too. There's a lot going on there. So don't think that you can't get a mortgage. Don't think that's not possible. Start exploring those options now. It's better to be pre-approved and understand what your capacity is, so when you start looking for a property, you can react quickly and not have to be beat out by somebody else. So again, I want everybody to start thinking about this now. Real estate now is looked at as a commodity. I mean, it's a nice to live in a house, but it really is now a numbers game, and everything is being financialized, so to speak. And it's because our market's being disrupted, and there are different players in our market now than there were in the last housing crisis, and we have to be fully aware of that. So educate yourself on financing options. There are many out there. As I mentioned as well, start looking around your neighborhoods. Go for a drive, all right? Look through Zillow and look at the foreclosed homes, the pre-foreclosure homes. Drive around neighborhoods. Start making notes as to what properties look a little bit distressed. Take a picture with your camera phone, all right? Write down the address. Go back home, research the property. Maybe something's going on with it. Maybe it's an opportunity for you. If there's not a for sale sign in front of it, there could be an opportunity right there that you're passing by. So start to become aware of your surroundings when you're driving around town and when you're driving around various neighborhoods, et cetera, et cetera. So, and again, you get home, you check out some information, look at the property appraiser, do some research on the property, see what's going on. You never know what you're going to find. And again, for us to never pay retail, this is the way I see it, to never pay retail, the average sort of owner-occupant buyer or the average sort of new mom and pop investor, we're going to have to go into uncharted territory to look a little harder for these deals in order for us to get our hands on better pricing, more equity, more flexibility in the transaction. So I look at it going, we have to sort of almost use the investor mindset and blend that with the retail approach. Because right now, just looking at properties, a lot of people are frustrated and they don't get what they need to get out of it. And again, another sort of comment that I've had from people is, and this is not a knock on the realtor community, it is what it is, that a lot of real estate agents are just contract processors. All right, here's a contract, we'll see what happens. Oh, they didn't want to buy it, they didn't want to go into contract, they didn't like your numbers, we'll move on. There's not a lot of servicing and negotiation going on average, which is frustrating a lot of would-be buyers. So please keep that in mind. So again, I just go back to the whole point of blending the two concepts. I think we now have to start blending retail buyers with investor concepts in order for people to be more open to look at different types of solutions or different types of ways of acquiring homes. Again, you don't have to buy things off the MLS, right? If it's a good deal, great. Or if you want to negotiate, wonderful. But if there's ways to get your hands on properties, because there are many that get you where you need to be at the price point you need to be, start looking at those, and I can hopefully help you with doing that. So again, please thank you very much for the views today. Thanks for the comments and the questions. I'd like to hear what you guys have to say. If you're not already a subscriber, please help my channel grow and subscribe. I'd really appreciate it. And again, reach out to me. My emails will be in the comments, and I can certainly assist you with guiding you in the right direction, giving you some ideas, or helping you understand and navigate this retail/investor market. You take care now.